For most people, gold is just another asset. Something that goes up when inflation rises. Something investors talk about when markets get nervous. But when a central bank keeps buying gold month after month, at record prices, with no regard for timing, and no sign of slowing down, that's not an investment decision. That's a signal. China has now added gold to its reserves month after month, relentlessly. Not once, not occasionally, but consistently, even as gold trades near historic highs. If this were about getting a good deal, they would wait. If this were about diversification, they would pause. If this were about portfolio balance, they would rebalance. They've done none of that. Instead, China keeps buying. And that's what should make you stop scrolling, stop multitasking, and actually pay attention. Because central banks don't chase performance. They don't speculate. They don't trade headlines. They prepare. Most analysts will tell you this is just China reducing exposure to the US dollar. That it's standard reserve management. That it's prudent, cautious, and boring. And on the surface, that explanation sounds reasonable. But here's the problem. When you look at what China is buying, what China is selling, and what China is building at the same time, the story changes completely. China is buying gold, aggressively. China is cutting its holdings of US Treasuries. And China is quietly constructing an alternative financial infrastructure that doesn't rely on the dollar, doesn't rely on SWIFT, and doesn't rely on Western trust. Those three actions together are not diversification. They are repositioning. Repositioning for a world where the current monetary order no longer works the way it used to. And here's where it gets uncomfortable. The gold numbers everyone sees, the official ones, don't make sense. China is the world's largest gold producer. Hundreds of tons come out of Chinese mines every single year, and almost none of it leaves the country. So where does it go? It doesn't show up in export data. It doesn't move through international markets. And it doesn't fully appear in official reserve reports. Which means one thing. What China admits to holding, and what China actually controls, are very likely two very different numbers. And this wouldn't be the first time. China has a long history of accumulating gold quietly, then revealing it all at once. After the accumulation phase is complete, when markets no longer have time to react gradually. That matters because gold isn't just a commodity. Gold is monetary credibility. It's what central banks turn to when trust breaks down. It's what remains when political promises fail. And it's the one asset that exists outside any single country's control. Which raises the real question. Why now? Why accumulate gold so aggressively in the middle of a fragile global economy? Why do it when prices are already high? Why do it while building new payment systems, new settlement rails, and new trade structures at the same time? The answer is not short-term profit. The answer is that China is preparing for a different monetary system. One where the dollar is no longer the only game in town. Not replaced overnight. Not destroyed. But challenged. And once you see that possibility, everything else starts to look very different. Because the next step isn't about gold itself. It's about how much gold China really has, and why keeping that information hidden might be one of the most strategic financial decisions of this decade. And that's where this story actually begins. Let's start with the numbers everyone repeats. According to official disclosures, China's gold reserves sit just above 2,000 tons. Respectable. Significant. But nothing extraordinary for the world's second-largest economy. On paper, it puts China well behind the United States, behind Europe as a bloc, and only modestly ahead of several mid-sized economies. If those numbers were accurate, there would be nothing to see here. But they're not. Because once you step outside the official reports and look at flows, not statements, the math stops working. China is the world's largest gold producer, year after year, by a wide margin. Hundreds of tons of gold are mined domestically every single year. And here's the critical detail most people miss. None of it is exported. Not some of it. Not most of it. All of it stays inside China. So let's ask the obvious question. If China produces that much gold, and continues importing gold through international markets, and keeps officially reporting only modest increases, where does the rest go? It doesn't vanish. It doesn't get consumed by jewelry demand alone. And it certainly doesn't sit idle. It accumulates, quietly, methodically, out of sight. And this is where analysts who track physical gold flows, not headlines, start raising eyebrows. Because when you add up domestic production, long-term imports, and historical behavior, China's official reserve figure begins to look less like transparency, and more like understatement. Some estimates suggest the real number could be double the official figure. Others argue it could be far higher. Not because China is lying for deception's sake, but because revealing the truth too early would destroy the strategy. Gold markets are thin compared to currency markets. Prices react quickly to large, confirmed buyers. If the world knew China was sitting on several times more gold than it admits, prices would spike instantly. And that would defeat the purpose. Strategic accumulation only works as long as the market doesn't fully understand what's happening. There's precedent for this. In the past, China went years without reporting meaningful gold purchases, only to suddenly announce a massive increase all at once. Markets were stunned. Not because the gold appeared overnight, but because it had already been there, hidden in plain sight. This strategy creates strategic ambiguity, and ambiguity in finance is power. It allows accumulation without interference. It allows preparation without resistance. And most importantly, it allows China to choose the moment of revelation. Because once those numbers are officially disclosed, they can't be taken back. Currencies reprice. Risk models change. Assumptions break. Which means the real question isn't whether China holds more gold than it admits. The question is why it's choosing not to tell anyone yet. And the answer lies in what China is not trying to do. This is not about returning to the old gold standard. Not about locking a currency to a rigid system that failed decades ago. What China is building is far more flexible, and far more dangerous to the existing order. Because it doesn't require replacing the dollar. It only requires offering something the dollar can't. And once that alternative exists, the rest of the world does the work for you. That's where this story goes next. Because to understand what China is really planning, you first have to understand what it isn't. And that brings us to the biggest misconception of all. At this point, most people make the same mistake. They hear gold, and immediately think gold standard, fixed exchange rates, rigid convertibility, central banks chained to metal, a system that collapsed under its own weight. And because of that, the conclusion sounds obvious. China can't do this. It won't work. History already proved it fails. But that assumption is built on an outdated framework. Because what China is preparing has almost nothing to do with the classical gold standard that ended in the 20th century. That system failed for a simple reason. It was too rigid. When economies faced war, recession, or systemic shocks, they needed flexibility. They needed the ability to expand credit, inject liquidity, and stabilize employment. Gold convertibility made that impossible. So governments chose discretion over discipline, fiat over metal. China understands that history better than most, which is why this strategy is not about tying every unit of currency to a fixed quantity of gold. That would be economically suicidal. Instead, China is working towards something far more subtle. A partial backing system. A hybrid model. One where gold doesn't limit monetary policy. It underwrites credibility. Here's the key distinction. In a classical gold standard, currency exists because of gold. In the system China is exploring, gold exists to support trust, not to dictate supply. The yuan remains a managed fiat currency domestically. The People's Bank of China keeps full control. Liquidity can still be created. Credit can still expand. Nothing changes inside the Chinese economy. But internationally the rules are different. For cross-border trade. For reserve holdings. For sovereign transactions. There gold becomes an anchor. Not fully convertible for everyone. Not available on demand to individuals, but accessible under specific conditions. To central banks and large institutions. Enough to prove the backing is real. Not enough to trigger capital flight or speculation. This is where China's dual-circuit model becomes critical. China already operates two versions of its currency. The onshore yuan, tightly controlled. And the offshore yuan, more flexible, traded internationally. Same currency. Different rules. Extending that structure to include domestic fiat flexibility and international asset backing is not radical, it's consistent, and the infrastructure to make it work is already being built. Offshore yuan markets, physical gold settlement mechanisms, delivery outside mainland capital controls. This creates something entirely new, a currency that behaves like fiat at home, but like a partially asset-backed instrument abroad. That combination is powerful. Because it avoids the weakness of fiat, total reliance on trust, without inheriting the weakness of gold standards, total rigidity. And it introduces something the current system lacks. Choice. Until now, the dollar hasn't dominated because it was perfect. It dominated because there was no credible alternative. Every other major currency was either too regional, too politically fragmented, or too lightly backed to inspire confidence during crisis. China doesn't need the yuan to replace the dollar. It only needs the yuan to become credible enough that central banks and corporations are willing to hold it alongside dollars. And credibility doesn't come from promises. It comes from balance sheets. Which brings us to the moment that changed everything. The event that forced central banks around the world to reevaluate what safe reserves actually mean. Because once that illusion broke, gold stopped being a relic and started becoming a necessity again. And that moment happened in 2022. Every monetary system runs on one invisible assumption: that reserves are untouchable, that assets held by central banks are politically neutral, that money stored in safe jurisdictions is truly safe. In 2022, that assumption died. When hundreds of billions in foreign exchange reserves were frozen overnight, not through courts, not through treaties, but through executive decisions, every central banker in the world took notice. This wasn't a sanction in the traditional sense. It wasn't a fine. It wasn't confiscation after legal proceedings. It was access denial. And that distinction matters. Because an asset you cannot access is not a reserve. It's a liability. From that moment on, holding reserves in someone else's system meant accepting someone else's politics. And once that line was crossed, the world's monetary psychology changed. Quietly. Permanently. Countries didn't issue dramatic statements. They didn't announce revolutions. They simply adjusted. They reduced exposure to assets that could be frozen. They questioned assumptions that had gone unchallenged for decades. And they began searching for alternatives. Not alternatives that were cheaper. Alternatives that were outside political reach. That search led almost everywhere to the same conclusion. Gold. Not because gold is perfect. Not because it yields income. Not because it's modern. But because it is neutral. Gold doesn't depend on payment systems. It doesn't require permission. It doesn't care about alliances. And crucially, it cannot be digitally frozen. That realization triggered something unprecedented. Central banks around the world began buying gold at levels not seen in modern history. Year after year, purchases exceeded historical norms. Not as a temporary hedge, but as a structural reallocation. Surveys of central banks showed something even more revealing. Almost none expected to reduce their gold holdings. Nearly all planned to increase them. Unanimity like that is rare in finance. And when it appears, it signals a deep reassessment of risk. This wasn't driven by ideology. It was driven by observation. If reserves can be frozen once, they can be frozen again. And the more fragmented geopolitics becomes, the higher that risk climbs. China understood this instantly. Because it wasn't just watching events unfold. It was imagining itself in the same position. Trade disputes, technology restrictions, geopolitical flashpoints. The lesson was obvious. Relying on a system you don't control means accepting vulnerability you can't hedge. So China accelerated. Gold accumulation continued. Dollar exposure was reduced. Settlement infrastructure outside Western control expanded. Not loudly. Not provocatively. Methodically. And while Western policymakers debated whether the dollar's dominance was under threat, China focused on something far more practical. What happens after trust erodes? Because monetary systems don't collapse overnight. They weaken through alternatives, through parallel rails, through optionality. By the time confidence breaks publicly, the replacement mechanisms are already in place. And that's exactly what China began building next. Not a declaration, not a confrontation, but an entire financial architecture that could function without the dollar, if it ever needed to. And that brings us to the infrastructure phase. Because gold without systems is just metal. But gold combined with settlement, custody, and payment rails becomes power. This is where many people get it wrong. They assume China's strategy is theoretical, that it's a vision, a long-term ambition that may or may not materialize. But the reality is far less speculative. China isn't talking about an alternative system. It's building one, quietly, incrementally, piece by piece. And the most important thing to understand is this. You don't challenge a dominant monetary system by announcing a new currency. You do it by building infrastructure that makes the old system optional. Start with trade. China is the world's largest importer of commodities: oil, iron ore, copper, agricultural products. For decades, Those transactions cleared overwhelmingly in dollars. Not because the dollar was ideal, but because there was no viable alternative. That's changing. More trade is now settled directly in yuan. Not for ideological reasons, but for convenience. If you're selling to China, and China is your largest customer, settling in yuan reduces friction. No dollar conversion. No exposure to dollar volatility. No reliance on Western clearing systems. At the same time, China has been steadily reducing its holdings of U.S. Treasuries. Not dumping them recklessly. Not triggering panic. But lowering exposure. Month after month. This matters because Treasuries are not just investments. They are the backbone of the dollar system. Less demand means higher yields. Higher yields mean higher borrowing costs. And higher borrowing costs expose fiscal weakness. China understands that leverage. But trade and bonds are only part of the picture. The real breakthrough is settlement. China has expanded offshore yuan markets, particularly through Hong Kong, creating a space where international participants can use the currency without entering China's domestic capital controls. At the same time, physical gold settlement mechanisms have been quietly upgraded. Gold contracts that allow physical delivery outside mainland China. Custody options that don't rely on London or New York. Storage facilities designed for international use. This creates something entirely new. An environment where foreign entities can hold yuan, convert it into gold, and take delivery, without touching the Western financial system. That single capability changes everything. Because now the yuan isn't just a promise backed by policy. It's connected, indirectly, conditionally, to a tangible asset. And this infrastructure doesn't exist in isolation. It's reinforced by parallel payment systems, designed to operate outside traditional messaging networks, blockchain-based settlement, local currency trade frameworks, direct bilateral clearing. These systems don't need to replace SWIFT. They only need to exist. Because once an alternative rail is available, sanctions lose power, financial pressure loses precision, and optionality emerges. This is where partnerships matter. Countries that already hold large gold reserves, countries wary of dollar dependence, countries that have experienced financial coercion firsthand. For them, this system isn't ideological. It's practical. It allows trade without alignment, reserves without vulnerability, settlement without permission. None of this requires a dramatic announcement. None of it requires the dollar to fail. It simply requires enough volume to make the alternative viable. And that threshold is closer than most people realize. But infrastructure alone isn't the endgame. Systems don't gain trust until markets are forced to reassess assumptions. And for that, something else is needed. A moment, a reveal. Because as long as China's true gold position remains uncertain, markets can debate, doubt, delay. Which is exactly why the timing of disclosure matters more than the disclosure itself. And that brings us to the most dangerous phase of the strategy. The one China is clearly saving for later. Here's the mistake most people make. They assume that if China were going to reveal its true gold holdings, it would do so during stability, during calm markets, during economic expansion, during diplomatic balance. That assumption is wrong. Because revealing massive gold reserves during calm conditions does almost nothing. Markets shrug. Analysts debate. Life goes on. Strategic revelations don't happen in calm. They happen in crisis. China doesn't need the world to celebrate a gold-backed yuan. It needs the world to need it. That's why the gold stays hidden. As long as markets believe no major economy has enough gold to credibly anchor a currency, the existing system holds by default. Fiat dominance continues. Not because it's trusted, but because it's uncontested. The moment that assumption breaks, everything changes. And China knows exactly what kind of moment creates that break. A debt ceiling standoff. A failed treasury auction. A regional banking crisis that spreads faster than policymakers can contain it. A sudden loss of confidence in fiscal sustainability. Moments when markets are already nervous, already searching, already questioning. That's when disclosure becomes a weapon. Picture the scenario. Markets are volatile. The dollar is under pressure. Investors are reassessing risk models in real time. And then the announcement comes. China reveals audited gold holdings far larger than previously disclosed. Not incremental. Not ambiguous. Verified. Documented. Undeniable. 10,000 tons. 15,000. More. The exact number matters less than the implication. Because in that moment, The unspoken rule of the post-1971 system collapses. That rule being, no major currency has meaningful hard asset backing. Once that's proven false, markets are forced to reprice credibility itself. Central banks don't need to sell dollars immediately. They don't need to panic. They only need to adjust. 5% less here, 10% more there. But when trillions are involved, small shifts become tectonic. In the first 72 hours, currency desks reevaluate exposure. Reserve managers update models. Finance ministries reassess dependency. And gold reacts instantly. Not because of speculation, but because scarcity has been redefined. Gold isn't suddenly rarer in physical terms. It's rarer in monetary relevance. At the same time, the yuan changes status. Not because it replaces the dollar, but because it now has something the dollar lacks. A visible anchor. Not a promise. Not a treaty. Not military backing. A balance sheet reality. And here's the most important part. China doesn't need full convertibility for this to work. It doesn't need citizens lining up to exchange currency for metal. It only needs sovereign credibility. Mechanisms that allow large holders, under defined conditions, to verify that backing exists. That's enough. Trust in modern finance is not binary. It's relative. If one currency has zero hard backing, and another has 5%, the difference is infinite, especially in a world where trust is already eroding. This is why the reveal is the endgame, not the starting point. Everything before it is preparation, infrastructure, accumulation, optionality. Everything after it is adjustment. Slow, persistent, irreversible. And once that adjustment begins, the system never fully goes back. Because credibility, once redistributed, rarely reconcentrates. Which brings us to the final question. What does this actually lead to? Is this the end of the dollar? Or something far more subtle and far more realistic? That's where this story concludes. This is where many narratives go too far. They predict collapse. They predict chaos. They predict the dollar disappearing overnight. That's not how monetary systems actually change. The dollar isn't about to vanish. It will remain dominant in American trade, in Western markets, in financial contracts written decades into the future. But dominance is not the same as monopoly. And monopolies end the moment a credible alternative appears. China doesn't need the yuan to become the world's primary reserve currency. It doesn't need to replace the dollar in every transaction. It only needs to do one thing: end the assumption that there is no alternative. A world where the dollar represents 60% of global reserves behaves very differently from a world where it represents 40 or 50. In that world, policy choices have consequences faster. Deficits are questioned sooner. Monetary expansion meets resistance earlier, because capital has somewhere else to go. A gold-anchored yuan doesn't destroy the system. It competes with it. And competition changes behavior. The Federal Reserve can still print, but it can't print without consequence. The Treasury can still borrow, but it can't borrow infinitely at artificial rates. Markets begin to impose discipline that didn't exist when the dollar stood alone. For China, success isn't absolute victory. It's optionality. A multipolar system where trade can settle outside the dollar. Where reserves don't have to sit in vulnerable jurisdictions. Where gold regains its role as the neutral foundation beneath currencies. Not a relic but a reference point. And that shift doesn't happen in a single announcement. It happens through thousands of quiet decisions. A central bank reallocating 5%. A commodity exporter choosing a different settlement currency. A corporation minimizing friction in its largest trade relationship. Individually, those decisions look insignificant. Collectively, they change the architecture of global finance. What makes this moment different from previous attempts is that the infrastructure already exists. The accumulation has already happened. The settlement rails are already operational. The partnerships are already in place. All that remains is recognition. And recognition usually arrives when the old assumptions fail under pressure. That's why this story matters. Not because it predicts the future with certainty, but because it explains the direction of travel. Monetary systems don't announce their endings. They evolve away from them. And right now the world is moving, quietly but decisively, toward a system where no single currency holds uncontested power. If you want to understand those shifts before they hit the headlines, before markets fully price them in, and before they become obvious in hindsight, that's exactly what we explore here. This is Finance Archives. If this kind of deep dive analysis helps you see the bigger picture, consider subscribing. Because the most important changes in global finance rarely happen loudly. They happen in the shadows, long before most people realize the rules have changed. And we'll be here to document them.